Welcome to the most in-depth analysis I have done to date on this channel. I'm going to give you a look at a great deal of data I have gathered on AerCap Holdings NV, ticker AER. I'm going to provide details on its valuation, growth, projections, risks, and whether I believe the risks warrant investment. Make sure you watch to the end before deciding whether this is an investment for you. Remember, this is a video for education and entertainment, and I am not a financial advisor. Regardless of whether you invest in this company, I hope that by watching my analysis of it, you will better learn how to do your own analysis and make better informed investment decisions in the future. This video took a huge amount of time to complete, so please like the video to get it out to more people who are interested. Let's get started. The first step to our analysis is understanding what AerCap is and how their business functions. You may not have heard of this company, but you have likely been impacted by it. Aircraft is not kidding when they claim to be the global leader in aircraft leasing. They own and manage over 1,000 aircraft, have a huge order book, and around 200 customers in 80 countries. They are the most active aircraft trader in the world, are the world's largest owner of commercial aircraft, and are the largest lessor of several major aircraft. Their business operates through three major segments. The first is leasing. They lease their aircraft to major airlines around the world. The second segment is trading aircraft. They purchase aircraft from manufacturers, investors, and other aircraft owners and sell aircraft to airlines. Their third segment is asset management. They provide asset services for managing an aircraft portfolio to their customers. This includes negotiating lease documentation, preparing aircraft for delivery, and managing the lease during the contract period. AerCap is impressively diversified across clients. As I mentioned, their customers are present in 80 countries and well distributed across 5 continents. These are just a small fraction of the 200 customers they have. As you can see, their customers are the largest airlines in the world. These are their customers just for North America. To get a sense of how big and dominant AerCap is, look at this chart. OEM stands for Original Equipment Manufacturer, which is the source of a particular aircraft component. Aircraft is by far the largest purchaser since 1995, dwarfing even the largest airlines like American, United, Delta, and Southwest. I showed you my Excel sheet for analyzing companies in my last 2 videos. I get the data I use for it from FastGraphs, Finbox, and Finviz. I'm going to take you through some of the data, but I will also show you how some of this data compares to AerCap's own historical data and to its competitors. When deciding whether a growth rate, level of debt, or valuation is good or bad, we should never look at that number by itself. We need to compare to the industry and to that company's own history to get a sense of its relative strength or weakness. Let's first look at historical growth. This company's 1-year earnings per share growth rate is an impressive 23.4%. Has consistently grown at the 3, 5, and 10-year level with 10 years at over 17% annual growth. This is very favorable. The cash flow growth rate is at 1, 3, 5, and 10 years is also excellent and always nearly at the double digits. The sales growth rate is at 6%, but this is still reasonable growth. However, if you look at price performance, you see it has done very poorly in the past year. As you can imagine, given the impact of the current crisis on travel, anything connected to the airlines has taken a hit. AerCap is no different, and it is in this drop in share price that there may be opportunities for us as investors. However, the issues with travel are risk factor number 1. When I pull up this chart I made on Finbox, you can see that since 2006, book value and retained earnings have grown rapidly. Revenue, cash from operations, gross profit, EBIT, and EBITDA have been fairly stable. Overall, these numbers are all favorable. However, take a look at the levered free cash flow at the bottom. This is risk factor number 2. Levered free cash flow is the amount of money a company has left remaining after paying all of its financial obligations. The levered free cash flow is at negative $1 billion in 2020. In other words, its current cash flow is not covering all of its financial obligations. In fact, as you can see in the chart, free cash flow has almost never been positive. Instead, it appears this company operates on debt or leverage. While it has done so successfully thus far, and they have been growing their free cash flow for several years, this is a more precarious position to be in and introduces some risk. However, there is far more to the story. Next, we look at forecasted growth. FastGraphs expects a decline of earnings per share of about 5%. However, because the share price has dropped so steeply, FastGraphs forecasts a fair value share price of $106 based on future earnings. Bear in mind, this is a company currently trading for $30. That would be a massive 248% total rate of return for the next several years, which would result in almost 62% annual returns. However, I disagree with this assessment and I do not believe earnings is the best way to value this company. Let me show you why. This is AerCap's price to earnings shown by the black line. The dark green are the earnings. It appears that earnings have almost no relationship to the price to earnings. Based on this, the company has been enormously undervalued since around 2007, with only one brief exception in 2014. Given the price is clearly not tracking earnings, and clearly the price is unlikely to come back to fair value based on earnings, What metric does the price track? The answer is price to EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Aircraft have a huge degree of depreciation. Because EBITDA looks at earnings before depreciation, EBITDA is a good metric to consider for valuing AerCap. When we look at the price to EBITDA, we see it has tracked the EBITDA growth rate closely up until a couple months ago when the crisis began. This further supports my belief that this is the better measure of value for this company. In fact, from 2008 until the end of 2019, the total rate of return was around 15%, whereas the EBITDA growth rate was around 12%. The stock price has already begun to bounce back, but what if it returns to the fair value it has been trading at for the last 15 years? We would see a 132.6% return, which will give us 38.4% annual returns until the end of 2022. Based on price to EBITDA, Fastgraphs projects a fair value of $71.09 on this company, which is currently only $30.57. A good question to ask yourself is how accurate these analysts are if we're relying on them. Well, this is their scorecard. You can see that they have been generally accurate or low every year since 2012, which was the last time that they were well above actual EBITDA. Since 2009, they overestimated EBITDA only twice. This gives me reasonable confidence. Looking back at our chart, according to Finbox, analysts' mean price target is $54 and the median price target is $50. Finbox sees $40 as fair value. While these are lower than Fastgraphs, this is because Fastgraphs' projected share price of $71 is over 2 years in the future. These analysts are only looking 1 year in the future. 1 year in the future, Fastgraphs is projecting a $49.59 share price, which is quite consistent with these other analysts. With projections of almost $50, $54, exactly $50, and $40.50, we are seeing consistency in the expectation that the $30 share price is going to explode. Moving on to the dividend, there is none, so that wraps that up. Although I am a dividend growth investor, and that is my primary focus, I do have a growth portfolio, and that is where this company would go. Looking at returns, while these percentages may look low to you, they are actually typical for the industry and range from the 53rd percentile up to the 66th percentile. Next, we have valuation. The valuation is amazing after the share price plummeted. A PE of 3.93 is incredibly low and well below the normal PE of 7 we see at the 5-year and 10-year mark. The forward PE is expected to be higher because of the projected drop in earnings. For PEG, or the price to earnings to growth ratio, we look for something ideally at 1 or below. AerCap's PEG is a very low 0.56. Price to free cash flow is also very low at 1.65. We can compare this to the 5 and 10-year normal price to free cash flow of 2.6 and see how low this is compared to where it typically is. Price to book, which is particularly important for asset-heavy companies like AerCap, is less than half of its 5-year average. Similar to the PEG ratio, we want price to book to be at 1 or below. This price to book ratio of 0.42 is incredibly low. Let me put this into the context of the industry for you. The PE is at the 11th percentile. The PEG ratio is at the 28th percentile. Price to free cash flow is at the 6th percentile. Price to sales is actually high at the 74th percentile, but price to book is down at the 19th percentile. Overall, these are all very low and shows it is a very good valuation, which we already saw looking at price to EBITDA on Fastgraphs earlier. On Finbox, I have plotted out price to book, price to last 12 months sales, price to operating cash flow, and price to earnings. We are currently at the lowest any of these ratios have been. Next up, we look at margins. Gross margins are around 94%. Operating margins are at 51%, and profit margins are at 25%. Do those margins sound huge to you? They should. For their industry, AerCap's gross margin is at the 99th percentile, operating margin is at the 97th percentile, and profit margin is at the 98th percentile. EBIT margin is at the 97th percentile. That is extremely impressive. Finally, we take a look at debt. Given I mentioned negative free cash flow and debt earlier, this is something we want to take a look at closely. Long-term debt to equity is very high at 3.49. Debt to equity is at 3.52. In other words, they have about 3.5 times more debt than equity. I prefer this to be below 1 and ideally even below 0.5. Despite this, short-term debt coverage is at 15.5 times, which means it can cover this debt in the short term. Interest coverage is looking further out, and I want to see at least a 2 as a minimum. It does meet this minimum, but only barely. Debt paydown yield is negative, which is a sign of growing debt. The credit rating is investment grade, which means default is less likely. As you can see here, they have investment grade credit ratings from all 3 major agencies, and they were even given these after the crisis had begun if you look at the dates. Next, we look at the quick ratio and the current ratio. Both are above a 2, which is a good sign. When these are below a 1, it shows a company's current assets on its balance sheet are insufficient to satisfy its current debt. Our scores above a 2 are a positive sign. Free cash flow yield is negative, which is not surprising given we saw free cash flow is negative earlier. This is of course a negative sign. Further, beta is over a 2, showing that this company's share price is more than twice as volatile as the markets. When we compare its debt to its industry, we see that its long-term debt to equity is at the 88th percentile, debt to capital is at the 87th percentile, and total debt to equity is at the 85th percentile. In other words, even for other trading companies and distributors, this company has a lot of debt. To summarize, this company has far more debt than I would like to see, but it appears that they have been managing it sufficiently well and are in a position to continue to make their payments. Their leverage and free cash flow are risk factors, but these are risk factors that have been present for over 15 years and which they've managed well so far. The final consideration is how the current crisis will impact AerCap through the travel industry. Whether they will give us massive returns given future growth and current undervaluation depends on their success with navigating this crisis. A huge aspect of whether this is a company you want to invest in is whether you believe air travel will rebound, to what extent, and how quickly. AerCap has its own thoughts on this, and I want to show you this for your investing considerations. First, AerCap shows that from 2006 to 2019, their fleet utilization has never dropped below 97.7%, even during the oil crisis, financial crisis, and European crisis. Here they demonstrate in their release on May 5, 2020, that approximately 98% of their lease rents through 2022 were already contracted, their average current lease does not expire until the third quarter of 2027, and their utilization rate for the first quarter, which is the first quarter of 2020, was 99%. In other words, even if airlines are not using their planes now, they are still paying for them. If the airlines don't use their planes for the next year even, they have to keep paying them. AerCap has these companies locked into leases. The only way AerCap suffers is if the airlines go bankrupt and default on their payments. Although I mentioned I do not like how high their leverage is, AerCap also notes its current leverage is the lowest it has been since 2014. Its secured debt to total assets ratio is at an all-time low, and 70% of its revenue are from higher quality customers like flag carriers, majors, and higher rated airlines, making it more likely that they will be paid. To reduce spending and ensure that they are safe, they have agreed on a huge number of deferrals and rescheduled deliveries, which has reduced their capital expenditures by $2.3 billion in 2020. They increased their coverage for their interest significantly, obtaining over $1 billion in new funding. In other words, they're taking big steps to ensure that they will make it through this successfully. It seems to be paying off. They show here that between their $4.7 billion in cash and their other sources, they have more than enough to cover their debts in 2020. After paying for their $3.8 billion in debt maturities and estimated cash capital expenditures, they will have $5.5 billion in excess. These moves are likely why we saw a big recent jump in the current and quick ratios. AerCap also points to the fact that they have newer planes with better technology. Looking at the global passenger fleet, 8% use old technology, 80% use current tech, and only 12% have newer tech. AerCap, by comparison, has no old tech, 41% current tech, and 59% new tech planes. This better positions them to have their aircraft used over others. Finally, AerCap posted this picture as a reminder that air travel is not over. While certainly it has slowed substantially, it has begun to recover and they see safety in their company given their current position. In summary, I believe AerCap is riskier than many of the companies I invest in given its leverage and free cash flow and its exposure to the travel industry. However, I see it as more stable and safer than investing in airlines and many other companies in the travel industry right now, especially given its long-term lease contracts. It only fails after the airlines have failed, and quite a few airlines would need to fail first given AerCap's customer diversification. I believe AerCap also has better potential upside than most airlines and other companies in the travel industry, given its projected growth and current undervaluation. If you are comfortable with investing in a company related to the travel industry, I believe this is a good investment. If you are fearful of the direction air travel is going, however, this will not be a company you can sleep well at night with, and you will want to look elsewhere. I hope this analysis has been helpful for you to better understand AerCap, but also to help you understand how to analyze companies and do investment research. As you can imagine, this video took a huge amount of time, so please like the video. Please make sure that you subscribe because I'm creating new videos for you every week. As always, good luck with your investing.